There's a number your bank doesn't want you calculating. It's called leverage, and the people who own 3 properties by 35 aren't smarter than you. They just figured out something you weren't taught on purpose. Here's the ugly truth. $100,000 in the stock market makes you $100,000 of exposure. $100,000 in real estate at 20% down makes you $500,000 of exposure. Same cash. 5 times the asset working for you. And when that asset appreciates, you're not earning returns on your money. You're earning returns on the bank's money too. That's not investing advice. That's math the wealthy have used for a century while telling everyone else to diversify into index funds. Today, we're doing the real math, not the Instagram guru math. Not the stocks are passive, so they're automatically better math. The actual spreadsheet, the actual tax code, the actual numbers, nobody puts in a 30-second reel. And by the end of this, you'll know exactly which one builds wealth faster in 2026, and why the answer isn't what either side of this argument wants you to believe. Because here's what nobody tells you at the start of this debate. This isn't a war between two assets. It's a war between two completely different games, with two completely different rulebooks, and most people are playing one game while judging it by the other game's scoreboard. Stocks are a liquidity game. Real estate is a leverage game. And if you don't understand which game you're actually in, you will lose money in both. Here's the lie you've been sold. And I want you to notice how comfortable it sounds. Just put your money in an index fund and let compound interest do the work. Sounds peaceful, sounds low stress. Sounds like something you'd hear from a guy in a cardigan on a podcast about minimalism. And it's not wrong. It's just incomplete in a way that costs the average person a house's worth of money over a lifetime. Here's the other lie from the other camp. Real estate is the only real wealth. Stocks are gambling. Buy property, it always goes up. Also incomplete, also costs people money. Just in a different, slower, more painful way. Usually the kind of pain that shows up as a cracked foundation at 2 a.m. or a tenant who stopped paying rent in March and you don't find out until June. The truth sitting underneath both of these lies is boring, and boring doesn't get clicks. So nobody says it. The winning asset depends entirely on your income, your risk tolerance, your time horizon, and the part nobody wants to admit, your personal willingness to deal with human beings in toilets. That's it. That's the whole secret. Anyone selling you a universal answer is selling you a course. So instead of picking a side, we're going to build the actual model, dollar for dollar, tax bracket for tax bracket. And I'm going to show you where each asset quietly wins, where each one quietly fails, and where the entire debate falls apart the second you factor in the one variable almost nobody puts in these breakdowns: what your money is actually allowed to do for you legally under the tax code while you sleep. Before we get into the numbers, hit subscribe, because this channel breaks down the actual mechanics of wealth that nobody explains in school. And if you want the next video where I expose the exact tax loophole real estate investors use to pay less than someone making half their income, that one's coming. Drop a like if you're the kind of person who wants the real math instead of the motivational nonsense. Let's get into it. Point 1, the leverage multiplier. Why equal capital is not equal exposure. Let's start with the number that breaks people's brains the first time they actually see it written out. Because everyone knows the word leverage, but almost nobody has sat down and done the arithmetic on what it actually means for their personal net worth. Say you have $100,000, genuinely saved, sitting in a brokerage account ready to deploy. Path 1. You put it into the S&P 500. You now have $100,000 of market exposure. If the market does its historical long-run average of roughly 10% nominal in a good year, you made $10,000. Solid, real. Nothing to be ashamed of. Path 2. You take that same $100,000 and you put it down as a 20% down payment on a $500,000 property. You now control $500,000 of asset with $100,000 of your own capital. The bank put up the other $400,000. That's not a favor. That's a business decision the bank made because real estate is collateralized debt they can repossess. And it's the reason mortgage rates are lower than almost every other form of consumer lending. Now, here's where it gets interesting. And here's where most people stop doing the math, because the next part requires actual multiplication instead of vibes. If that property appreciates at a conservative 4% in a year, which is below the long-term historical average for most US metro areas, that's not 4% on your $100,000. That's 4% on the full $500,000 asset. $20,000 of appreciation on the same $100,000 of your own capital. That, in the stock scenario, only made you $10,000. Same money. Double the dollar return. Not because real estate is a better asset intrinsically. It's not. And anyone who tells you real estate always outperforms stocks on a pure asset class basis is lying to you or hasn't looked at a 100-year chart, but because of the leverage mechanism wrapped around it. You're getting paid on money you don't own. Here's the psychological root cause of why almost nobody exploits this properly, even after they understand the math. It's called debt aversion bias, a documented behavioral finance pattern where humans process borrowed money as inherently more threatening than owned money, even when the borrowed money is secured against an appreciating, cash-flowing asset with a fixed, predictable repayment schedule. Your brain doesn't do net present value calculations. Your brain does, I owe someone $400,000, and triggers the exact same anxiety response as if you owed a loan shark. It cannot tell the difference. difference, on a gut level, between productive leverage secured by a real, insurable, appreciating asset and reckless debt. That's why so many people with plenty of savings never buy real estate. Not because the math doesn't work, it works extremely well, but because their nervous system vetoes the decision before their calculator ever gets a chance to run the numbers. Here's your non-obvious execution rule. And this is the part that separates people who actually build wealth from people who just watch videos about it. Never evaluate leverage in isolation from your cash flow buffer. The leverage multiplier only works in your favor if you can service the debt through a downturn, a vacancy, or a rate reset without being forced to sell at the wrong moment. The single biggest destroyer of real estate wealth isn't bad property selection. It's buying at the edge of your monthly cash flow with zero reserve, then getting hit with one bad tenant or one furnace replacement, and being forced into a fire sale 18 months later at a loss that erases every leverage advantage you had on paper. Rule of thumb, and write this down: 6 months of full mortgage payments sitting in reserve untouched before you even think about the leverage multiplier working in your favor. Leverage cuts both directions. It multiplies your gains on the way up. It multiplies your losses and your stress and your risk of forced liquidation on the way down. Anyone who shows you the upside math without showing you this is selling you half a picture. Point 2. The liquidity tax, what illiquid actually costs and saves you. Now let's talk about the thing stock evangelists love to bring up, and they're not wrong to bring it up. Liquidity: you can sell stock in 3 seconds from your phone while sitting on the toilet. You cannot sell a house in 3 seconds. You cannot sell a house in 3 weeks, most of the time. Closing on real estate realistically takes 30 to 90 days, involves a lawyer, an inspection, an appraisal, and a buyer who also needs financing to cooperate with the universe. Here's the math. Nobody runs on what that illiquidity actually costs you. And here's the twist: it's not what you think. Liquidity feels safe. It is not automatically the same thing as being safe. Financially, here's why. Liquid assets are liquid for you, and liquid for everyone else, at the exact same moment, which means in a genuine downturn, when everyone panics simultaneously, that liquidity becomes the mechanism that destroys wealth fastest. In March 2020, the S&P dropped over 30% in about a month. People who were liquid sold at the bottom because they could, in a panic in seconds from their phone at 2 a.m., at the worst possible price. That same month, real estate values barely moved on paper because there was no mechanism for millions of scared homeowners to simultaneously dump their houses at once. The illiquidity was, functionally, a forced discipline device. It protected people from their own worst emotional decision by making it structurally difficult to execute. Now, let's run the actual math on the flip side, because illiquidity isn't free either. Say you need $40,000 for an emergency. If it's in stocks, you sell $40,000 of stock, pay capital gains if it's outside a retirement account, and you're done in 2 business days. If your equity is trapped in a property, your options are a home equity line of credit, which takes weeks to set up and charges interest, or selling the entire asset, which takes months and costs you 6% in realtor commissions alone on a $500,000 property. That's $30,000 gone before you've paid a single closing cost. That's the liquidity tax. It's real, it's expensive, and anyone who tells you real estate has zero downside is lying to your face. The psychological root cause here is present bias colliding with asset permanence anxiety. People overweight the emotional comfort of, I could get this money tomorrow if I needed to, even when statistically they will almost never actually need $40,000 overnight, and that overweighted comfort causes them to keep too much capital sitting in low-growth liquid vehicles for decades, purely for a psychological safety blanket they use maybe twice in their entire adult life. Execution rule. And this is the one that actually resolves the whole liquidity debate instead of just arguing about it. Don't treat liquidity as a property of the asset. Treat it as a property of your overall portfolio. You don't need every dollar liquid. You need enough dollars liquid. That's an emergency fund. 3 to 6 months of expenses in cash or cash equivalents, sitting completely separate from your investment strategy. Once that buffer exists, the illiquidity of real estate stops being a threat and starts being an asset, because it prevents you from panic selling and appreciating property during a scary news cycle, the exact mistake that liquid stock investors make constantly, and the exact reason the average stock market investor's actual returns, according to multiple long-run studies from firms like Dalbar, badly trail the market's actual returns, purely because of behavior-driven mistiming. Illiquidity, once you've built your buffer correctly, becomes a discipline mechanism working in your favor instead of a risk working against you. Point 3. The tax code was not written for you, it was written for owners. This is the point in the video where I stop being diplomatic, because this is the part of the math that gets deliberately left out of most stocks versus real estate content. And it's the single biggest reason real estate investors quietly outpace stock-only investors at the same income level. The tax code, as written in the United States, treats an employee's income and an owner's income completely differently, and it is not close. Here's a scenario. 2 people, each with $200,000 of gains this year, Person A made it selling stock they'd held for over a year. Long-term capital gains, taxed at 15 or 20% depending on bracket, straightforward, no tricks available. Person B made it through real estate, rental income, appreciation, and a cost segregation study on a property they bought 18 months ago. Here's what person B has access to that person A does not. Depreciation. The IRS allows you to deduct the theoretical decline in value of a building over 27.5 years for residential property, even while the property is in reality appreciating. That's a paper loss the tax code hands you on an asset going up in market value purely because you own it. A cost segregation study can accelerate a huge chunk of that depreciation into the first few years instead of spreading it evenly, which can offset a massive amount of that $200,000 in taxable rental income, sometimes almost all of it, depending on the property and the study. Then there's the 0,031 exchange, a mechanism with zero equivalent in the stock market. Sell a rental property, roll the entire gain into a new property of equal or greater value within the strict timeline, and you defer the capital gains tax entirely. Not reduce it, defer it. Indefinitely if you keep exchanging. Person A, selling stock, cannot do this. There is no mechanism to sell Apple stock and roll the gain into Microsoft stock without triggering a taxable event. None. That door simply does not exist for public equities, and then there's the move that actually built generational wealth for people who understand it, cash out refinancing. Person B's property appreciated by $100,000. They can refinance, pull that $100,000 out as a loan against the new equity, and that money is not taxable income because it's debt, not a sale. They can use it to buy another property, and the rental income from the original property covers the new, slightly higher mortgage payment. Person B just accessed $100,000 of their gains, tax-free, while still owning the appreciating asset. Person A, to access $100,000 of stock gains, has to sell the stock and pay capital gains tax on the way out. There is no equivalent refinance my stock portfolio without selling it mechanism available to a retail investor at meaningful scale without taking on margin risk that most advisors would call reckless. This is not a loophole in the sense of something shady. This is the tax code functioning exactly as intended by the people who wrote it, because the tax code, going back to its origins, was written substantially by and for property owners and business owners, not for WS2 employees buying index funds. It rewards ownership, risk-taking, and job creation through housing supply. It does not particularly reward passive equity holding beyond the relatively modest long-term capital gains discount. The psychological root cause of why most people never touch these tools, even after learning about them, is complexity avoidance, a well-documented tendency where people default to the simplest available option, even when it's financially inferior, purely because the more powerful option requires learning new rules, hiring a CPA who understands real estate, and doing paperwork that feels intimidating. Index funds win the popularity contest partly on merit, and partly because buy VOO and don't think about it requires zero specialized knowledge, while depreciation schedules and 1031 timelines require you to actually become somewhat financially literate. Execution rule. If you own investment real estate or you're considering it, you need a CPA who specializes in real estate specifically, not a general tax preparer, before you file your next return. This is the single highest leverage financial hire most real estate owners never make, and it routinely pays for itself many times over in the first year alone through deductions a generalist accountant simply doesn't think to look for. Point 4. The effort-adjusted return. What nobody puts in the spreadsheet. Here's the variable that ruins every clean comparison chart you've ever seen on this topic, and it's the reason I said at the start that the winning asset depends on you specifically, not on some universal formula. Stocks require essentially zero ongoing labor once purchased. You buy an index fund. You can genuinely ignore it for a decade, and it will do exactly what it's going to do regardless of your involvement. That's not a small advantage. That's the entire value proposition of passive investing. And for a huge percentage of the population, people with demanding careers, people with young kids, people who simply do not want a second job, that zero labor requirement makes stocks the objectively correct choice. Full stop. Even if the raw dollar math sometimes favors leveraged real estate on paper. Real estate is not passive. I don't care what anyone selling a real estate course tells you. Even with a property manager taking 8 to 10% of rent off the top, you are still the person who gets the call when the property manager can't handle a legal eviction. Still the person approving a $5,000 roof repair. Still the person whose credit and financial life is directly tied to whether a stranger pays rent on time. This is a part-time job wearing an investment costume, and the return has to be evaluated against the hours it actually consumes. Let's do the real math on that. Say managing a single rental property, even with a property manager handling day-to-day operations, costs you 3 hours a month of genuine mental and logistical overhead, reviewing statements, making decisions, occasionally dealing with something the manager escalates. That's 36 hours a year. If that property nets you an extra $15,000 a year over what the same capital would have made in stocks, once you factor in leverage and tax advantages, you're effectively paying yourself around $417 an hour for that 36 hours. That's an extraordinary hourly rate, and it makes the case for real estate very strong for that person. But if you're managing 3 properties yourself, no property manager, doing your own repairs, doing your own tenant screening, you might be looking at 15 to 20 hours a month, 200 plus hours a year, and suddenly that same $15,000 advantage over stocks works out to roughly $75 an hour. Still solid, but a completely different proposition, and one that depends entirely on what your actual time is worth in your career and what you'd otherwise be doing with those hours. The psychological root cause of people miscalculating this is what behavioral economists call the sunk effort fallacy combined with underpricing your own time. People who get into real estate rarely track the actual hours honestly, because admitting how much time it consumes would force them to confront whether the return is actually worth it. So they round the labor down to not much in their head to protect the story they've told themselves about being a savvy investor. Execution rule. Before you buy your first rental property or before you buy your fifth, track your actual hours for 90 days on your existing properties or interview 3 people who already own similar properties and ask them directly how many hours a month it consumes, no sugarcoating. Then run your own personal hourly rate math before assuming real estate automatically wins. For a surgeon making $400 an hour in their actual profession, 36 hours of landlord work might be a terrible trade even at a high return. For someone whose alternative use of that time is scrolling their phone, it's an incredible trade at almost any return. The harsh reality and the action plan. So here's the harsh reality stripped of everything except the actual conclusion. Real estate wins on leverage, wins on tax treatment, and wins on the multiplier effect of using someone else's money to control an appreciating asset. Stocks win on liquidity, win on zero labor, win on diversification, and win on accessibility. You can start with $50, not $50,000. The people who actually build serious wealth by their 40s and 50s statistically usually aren't purists. They're not all in on one side of this argument. They use stocks as the liquid, boring, zero-maintenance base of their portfolio precisely because it demands nothing from them, and they use real estate once they've built enough capital and stability as the leveraged, tax-advantaged accelerant layered on top once they have the reserves, the time, and the tolerance to actually manage it, or the income to pay someone else to. Here's your action plan for tomorrow morning, and I mean literally tomorrow morning, not someday. Step 1. Pull your last 12 months of income and expenses and calculate your actual savings rate as a real percentage, not a guess. You cannot make this decision intelligently without knowing this number cold. Step 2. If you do not have 3 to 6 months of expenses sitting in a genuine emergency fund, stop reading real estate content entirely and build that first. This isn't optional. This is the buffer that makes leverage safe instead of dangerous, and skipping it is how people end up in the forced sale scenario we talked about earlier. Step 3. If that buffer already exists, open a brokerage account tomorrow if you don't have one, and automate a monthly contribution into a low-cost index fund, even if it's small. This becomes your liquid base layer regardless of what you decide about real estate. Step 4. Spend the next 90 days doing real research on your specific local real estate market. Actual cap rates, actual rent-to-price ratios in your area, not national averages. Because real estate is a hyper-local asset and national statistics will mislead you badly about your specific city. Step 5. Interview a real estate specialized CPA before you buy anything, not after, so you understand the tax mechanics we discussed while you're still deciding, not scrambling to retrofit them onto a purchase you've already made. That's the plan. Not motivational, not complicated. Just the sequence that actually protects you while positioning you to use both of these tools correctly, instead of picking a tribe and defending it on the internet. And if you actually want to see how the wealthy stack tax advantages on top of exactly what we just covered, the specific structures that turn a single rental property into a legal repeatable tax reduction machine, I already broke that down in full in the video on this channel about how the top 1% legally pay a lower effective tax rate than someone making $90,000 a year. That video connects directly to everything we just walked through, and it's the natural next step if you actually want to build this strategy instead of just understanding the theory. Go watch that one next. I'll see you there.